Good afternoon, everyone. Thank you so much for the organizers for inviting me to share some of the views that we have on the macro markets and the global economy these days. I think that any discussion about the global outlook, and I don't know if this is providing too much of an echo, has to start with the U.S. and just as a key driver for the global economy. One thing that is very interesting is that because of the policies that the new U.S. administration of President Trump had been pushing since taking over earlier this year, if you look at the forecast that we had for growth, for inflation, for this time of the year, basically the second half of 2025, we were expecting already a much deeper deceleration. We were expecting prices to be higher. And what we have seen is quite a bit of resilience. Our economies have been forced several times, actually, to increase the growth projections, at least for the third quarter of this year. And this has happened not only in the US, but also here in Europe and in many places around emerging markets. So there is this dynamic, this element of resilience that you ask the question, well, you know, there's quite a bit of shock, quite a bit of uncertainty. If you look at business sentiment indicators, consumer sentiment indicators, they're all pointing south. So you would say, okay, why is it that with this soured mood, we're still having such strong growth and inflation not receiving yet much of an impact from the tariffs? When you start to dig in and try to see why is this happening, at the same time, as you know, labor market indicators in the US have been pointing south. The so-called payroll prints have been weakening. The past 3 months already below 50,000, which is already starting to like flash red light. The explanation is probably a simple one, which is there is quite a bit of capex happening in the US and in other parts of the world. This capex is heavily concentrated in the tech sector. So at the end of the day, AI or the investments related to AI, data centers or the like, seem to be saving the day. And as you know, tech investment is capital intensive, is not labor intensive, and that is how you have this coexistence between a very strong headline growth level, yet weakening in the labor market, right? And the question going forward is tech going to continue to save the day and continue to compensate or offset the weakness that we're seeing elsewhere? If you look at the projections that our economies have, the answer is no. But it is a qualified answer, meaning we will see deceleration. The fourth quarter will probably be weaker. The first half of next year will probably be weaker. But the magnitude of that weakness could still be tempered or ameliorated by what is happening in tech. The uncertainty related to that US tariffs is still there. At this stage, the average tariff that the US is imposing on the rest of the world is around 16.1%. This number used to be less than 3% at the beginning of this year, so it's multiplied itself by more than 4 times. There is the effective tariff. If you start to net out a lot of exceptions, some sectors are exempted, some countries have managed to negotiate lower tariffs, etc. The effective tariff is probably closer actually to 10%, not the 16.1% headline. And that is why the pass-through from these tariffs onto inflation has been still relatively modest. That said, inflation is hovering very close to 3%. The expectation is that it's going to get to 3.5% on average in the fourth quarter. Remember that the Fed has a target of 2%, so that is certainly in an uncomfortable place. But despite that, because of the weakness in the labor market, we saw the Fed literally resuming the easing cycle this week. They delivered 25 basis points. The signaling is that they are going to do more. Our economies are expecting 3 more cuts. Basically, the policy rate that at the beginning of this week was 4.5% will get to 3.5% by the first quarter of next year. And that is going to provide a bit of a cushion. So next year, even though we're going to have a slowdown, at some point we're going to see potentially some recovery of growth. So recession is not in the horizon, although we need to watch very carefully further deterioration in the labor market, right? And just as a reminder, recession, you don't go gradually into a recession. Recession just happens. It is basically when all of a sudden economic agents, be companies or be us as consumers, decide that we need to hold off from spending, we need to hold off from investing because of ABC, too much uncertainty, we fear for our jobs, there is a deterioration of sentiment, and you could have a situation where everything looks fine, and in 2 months, boom, you're in a recession. So that's why the recession probability, our economists are still keeping a relatively high probability of 40% over the next year. Granted, it's not the base case, so the projections don't point to recession, but the risk is certainly there. So what are the things that we're watching? So, well, this is a bit of the story in the US. Let's come to Europe. We're sitting here in this beautiful location in Europe. There's been certainly, and maybe potentially because of the pressure coming from the policy stance of the US, there's been a bit of a wake-up call in Europe about, hey, Europe needs to do more for itself, right? Meaning spend more, don't rely on the security umbrella in the US because you don't know whether you'll have it when you need it. Germany has, as you know, broken up with a taboo and has been promising to spend more in infrastructure, which is clearly needed. So all of a sudden, there is a sense that there is a bit of a higher floor on growth that we're going to see in Europe. European growth, as you know, has been very low for quite a bit of time. So there is some hope that this is going to increase. And the ECB probably may cut one more time. That is the forecast that our European economies have. The market is not fully believing it. It's not fully pricing that in. So when you look at the situation that I described in the US, slower growth, the Fed cutting rates, inflation going up. In the case of Europe, growth, looking okay, with some hope that once all this investment starts to happen, that it could be a little bit higher. You then have the ingredients of why we're still very cautious with the US dollar, thinking that there's probably more weakness in the US dollar in store. The projection that we have for euro dollar is maybe around 122 sometime in the first half of next year. It's only like 3-5 cents away, so it's not a big move. But again, the direction of travel we think is still for more dollar weakness. And what is interesting is that the dollar weakness should not only manifest itself against other reserve currencies, but also against many emerging market currencies. So all of a sudden, there's a lot more interest of global investors in looking at emerging market opportunities, literally after 3-4 years in which we have not seen money coming into EM. So all this is proving not everything is negative, right? All this is proving to be supportive for markets away from the US. Now, in the US itself, as you know, equity markets are very close or at historical highs. Credit spreads in the US and elsewhere are very close to historical tights. So the market seems to be pricing a bit of a Goldilocks scenario. All the things that I'm talking about here are being mentioned as a risk, but are not being discounted in prices. So we need to be mindful that if once there is deceleration, we have higher prices, that will potentially start to have an impact on markets. So these are the key things to watch on the macro side. On the more political, geopolitical side, the things to watch, well, I don't need to mention the geopolitical hotspots. Is honestly very difficult to put a finger or to put probabilities as to what is going to happen in Russia, Ukraine, what is going to happen in the Middle East. What is clear, though, is that the market doesn't seem to be pricing in too much of risk premium pretty much anywhere related to geopolitical risks. Maybe because historically, every time, for example, oil prices start to go up because of geopolitical tensions, it has proven to be, quote unquote, a fate, a reason to start selling. Very recently, we have seen oil prices starting to go up a little bit, but it's not about geopolitical risk. It's really more related to China buying like there's no tomorrow. China has been accumulating stocks of inventories of commodities, metals and oil, and some agricultural commodities as well. Begs the question as to why are they doing that. Probably there's some kind of geopolitical calculus there, but that is what is putting a lot of support for commodity prices. One other thing that we are monitoring, and this is something that obviously is problematic if it continues, is this sense that there is an erosion of institutions in the U.S., particularly when we look at what is happening in the political pressure that the Fed is facing to cut interest rates further. There's been now, even an attempt to fire one of the FOMC members. There is a process in place that every 5 years, all the regional Fed governors need to be recertified, reconfirmed. This process has been there forever. That's part of the institutionality of the Fed. It has always been some type of bureaucratic process. No one would pay attention because they would all be recertified and reconfirmed. But because this is coming in this type of environment of political pressure on the Fed to cut rates, it is possible that that window of recertification that is going to happen, I believe, in February next year, could be used by the US administration to maybe look to do a bit of more of a wholesale replacement of several members of the FOMC, which if it were to happen, it would obviously be very problematic because then the concerns about Fed independence that are already in the surface, that are surfacing but not being priced by the market, would really need to be priced by the market. What would be that type of pricing? Well, this is probably something that could generate a reaction in equity markets, right? This for sure would lead, maybe the short end of the curve to price more cuts because the Fed will be under pressure to deliver more. But the long end of the yield curve in the US, because of the uncertainty and the fact that the markets would start to feel that, okay, the Fed has two mandates, right? Inflation and growth. But if there is a loss of Fed independence, probably that type of 50-50 mandate would become like, okay, inflation is something to worry later. Let's focus on growth, which means that inflation expectations will probably de-anchor and the market would start depressing higher inflation in the medium term. So what you would see is that the yield curve would steepen, meaning the long end yields go higher, the short end probably go lower. And that could also spell trouble for the dollar. I mean, I come from emerging markets research. I have seen so many cases, and you probably have all too, of countries where you do see political pressure on central banks to cut interest rates. You know that what happens next is not pretty, right? You do have this yield curve steepening. You do have a hit to confidence. You do have currency weakening, and of course, inflation going higher. That is not a good mix, and it's actually remarkable that we're talking about all these things that are very EM-esque, referring to the US, but that is the world in which we live in. So a lot certainly to watch for the months ahead. What else to mention? Well, I already said weaker dollar is leading EM currencies to appreciate. That is helping disinflation. Another thing that is helping this inflation is what is going on with China. So China, as you know, some years back had a problem with a real estate bubble that basically burst. And the construction sector has been dragging growth for several years now. The construction sector directly represents maybe 9% of GDP in China, but if you look at all the sectors that are somehow reliant or connected to construction, the number goes up almost to 20%. So no wonder why China, we used to have growth in China of high single digits or even double digits. Well, that's history. Right now we are, with a lot of policy support, we're hovering around 5%. Now, the Chinese, the way in which they have been achieving this 5% is by providing a lot of incentives to its manufacturers to produce a lot more than what the domestic economy can absorb. So they rely a lot on exports. And now all of a sudden, the US is imposing tariffs. is saying no more. If you look at the shipments from China to the US, they have literally collapsed. So what China is doing, that whatever they cannot sell to the US is turning around and selling it to the rest of the world. A lot coming to Europe, a lot going to the rest of Asia. Even in Latin America, countries are complaining that manufacturers are facing stiff competition from cheap imports coming from China, right? So it is a model that, is not sustainable, but certainly China continues to do that because they need to keep growth high in their own economy. And that is actually helping to also contain inflation around the world. So part of the disinflation process we're seeing away from the US, so in the US, I told you the risk for inflation are on the upside. In the rest of the world, the risk of inflation is actually on the downside. One ingredient is Chinese chip exports, right, that are proving to be disinflationary. So when you add this to the mix, then you have a situation that in emerging markets, central banks are in a position to cut interest rates further. That is going to help also attract more capital flows. That's why it's a bit of a Goldilocks scenario for EM, because you have this inflation, you have stronger currencies, you have central banks cutting rates, and you have growth that so far has been resilient. So what's not to like, right? So we think that this is a trade that probably has more to go, and that's why we're still constructive there. So to wrap up, and I wanted to leave some time for questions. A lot of sources of uncertainty. It's a topic of discussion, but markets, generally speaking, are not pricing much of that uncertainty, which is good news if you're invested in the market and you feel it in your own PA. But it's a little bit scary in knowing that the day of reckoning could come one of these days if some of these risks intensify. So I think it's just important to keep them in mind, and it is important that if some of these risks play out, just to understand, okay, what kind of market impact that repricing could take. Let me stop here and maybe take the next 8 minutes some questions, if any. Please.
I'm doing like a hobby investing majorly in USA. And how do you see the situation with the debt, like accumulating a lot in USA, and the interest rates that are like 14% of US GDP in the long term? How do you see the situation resolving?
You're talking about the US?
Yeah.
The debt in the US?
Yes.
Yeah. So public debt is a problem in many countries. We used to feel that that's a problem in emerging market economies, but that has become a problem in many developed market economies. The US debt to GDP, public debt to GDP, is hovering around 100. The projection, when you look at the fiscal deficit of the US this year and the last couple of years and the forecast for the next couple of years, it is hovering between 6–7% of GDP. This type of deficit is very high for a moment where there's no external shocks, no wars. You don't have the pandemic or you don't have a financial crisis. So in the US, historically, in years where there's no such events or shocks, the fiscal deficit used to hover around 3%. Now it is 6% with a projection that actually next year could be closer to 7%. So that is a source of, obviously, uncertainty and anxiety. And when you look at the shape of the US yield curve, it is steep because of the fiscal outlook. Now, the way in which the Treasury Secretary, Scott Bessent, has been addressing that is that they're focusing a lot of their issuance in the short end. So they're issuing a lot of T-bills as opposed to extending duration, meaning issuing long-term debt. So they're trying to reduce the pressure in the long end. And that has allowed the curve has steepened, but it's not blowing up, right? But that is a concern. And when you see that what central banks around the world, reserve managers that are thinking about the long term, they are the quintessential long-term investor, you have seen that they have been reducing dollar holdings as part of the FX reserves portfolio. a lot of that is related to the fiscal outlook of the U.S. Because we have seen this movie so many times before. When any country becomes heavily indebted, what do? Well, you try to inflate away your problem, right? Inflation is higher, devaluation intensifies, right? So that's why the debasement of the dollar is a fear because of the fiscal outlook, and that is one reason why FX reserve managers have been de-dollarizing their portfolios. But the US is not alone on that one, right? I'm based in London, in the UK. That's a big problem, and we have seen it in France. One key reason why France has had, 4 prime ministers in a year, I think, is because they cannot, find a fiscal solution that is politically acceptable to address France's fiscal problems. Well, let's not talk about Japan or other countries, right? So I think that the fiscal outlook is a source of concern in many parts. It's not only EM, now it's also DM, which means that long-end interest rates are probably going to be high for a long period of time, right? Because the market is going to be demanding a higher yield in order to finance these deficits. Yes.
Hello. Question. If the pressure on Fed results that they lower the interest rates, and if this initiates a wave of inflation, the strong one like after COVID in United States, how it's going to affect Europe? Is it going to spill over? Can we expect the same wave of inflation in Europe and in Croatia as a consequence?
It is, I think, the inflation problem in the US coming from, let's say, unanchored inflation expectations, right? So you have this hit to Fed independence, inflation expectations get de-anchored, you start to see inflation markets. So there's a market, as you may know, of what we call inflation break-evens. Inflation break-evens, if you look at the medium long term, 5-year, it is still hovering around 2.5%. So you can say that the Fed has not lost, despite all the drama of in recent weeks, fortunately has not lost its credibility. The market is still expecting inflation to be okay in the medium term. That would change, right? If you have something a lot more dramatic against the Fed and against its independence, you will probably see inflation markets spiraling, that number going higher. There will probably be some contagion at least on the market side, that any other country that has high debt will probably start to see markets anticipating something similar. So I cannot tell you that that is going to spread to every country, right? And of course, if you're importing a lot from the US, there is the possibility of contagion just because you're going to be importing things that are at a higher price, right? So, but I think that for the time being, the issue of Fed independence seems relatively concentrated on the US as a problem, right? That is not spreading to the rest of the world. But, the US is the most important market. So probably the impact may not be on inflation in Croatia or inflation in Europe. The impact will be on the market, right? Because if you have something dramatic with Fed independence, believe me, the equity market is going to go down, right? The credibility of US institutions is going to be undermined. The appeal that we all have to have US assets, dollar assets, is going to be shaken. So in this recomposition, you have a correction, and this type of corrections ends up being what we call these risk-off scenarios that all of a sudden there's no place to hide, right? So you have correlations all of a sudden being heightened in terms of corrections everywhere. So I would be more concerned about market contagion as opposed to inflation contagion necessarily.
Have one returning question.
Yes, hello again. I have a question about the reserve vault currency. We are seeing that China is now as you mentioned, they are stocking on the rare earth materials, and they have the global market share of rare earth materials. Also, their brands are becoming globally more and more dominant, and their technology. And do you see maybe in forward years that the dollar is at risk of losing its reserve currency?
Yeah. So a couple of things there. China has been trying to quote unquote internationalize the renminbi, its currency, asking they would like to see more countries using renminbi for payments, for reserves, for transactions, etc. And they have had, some relative success. So if you look at the dollar, over the past 10, 15 years, the share of the US dollar on FX reserves of central banks around the world has come down maybe around 10%. The renminbi has gone up from 0. No one had renminbi in reserves before. Now it's around 2%. So you ask the question, okay, what has replaced the other 8%? Well, it hasn't been the euro, it hasn't been the British pound, it hasn't been the yen or Swiss franc. It's actually been gold. Gold now accounts for more than, it's almost like 22% of central bank reserves around the world. It's now taking over the euro as the second asset in reserve management. Everyone is buying gold. Gold, as you know, it took 12 years, I think, to go from 1,000 to 2,000, 4 years only from 2 to 3,000, and at the pace at which we're in, we may see 4,000 before 1 year, is up. We crossed that boundary earlier this year. So gold looks like it's the ultimate, quote-unquote hedge against all the uncertainty and the policy dynamics that we're seeing, and certainly the concerns of the fiscal outlook, etc. Now, the reason why I don't think, and we don't think, that the Chinese renminbi is going to take over or is going to regain much more of market share is because China still has capital controls. The capital account is not open. You cannot go to a bank and open a renminbi-denominated savings account. You and I cannot trade renminbi without going through the Chinese financial system, right? So it is not a convertible currency. So, and I don't think we're going to see in our lifetime the Chinese fully opening up, allowing people to trade its currency without their own intervention. So, which means that is going to limit how much the renminbi can become, or could eventually, challenge the dollar, right? That said, as I said, there are some areas of de-dollarization. One is FX reserves, right? Going 10% lower, gold taking up. Another area of de-dollarization has actually been commodities trading. There was a time when you would talk about petrodollars because there was a strong correlation between the price of oil and the multilateral price of the dollar. That correlation has shrunk a lot. Why? Because now almost around 20% of oil is traded and settled. The payments of oil are settled away from US dollars. Why so? Because you have Russia, Iran, Venezuela. The three countries account for 20% of global oil production. They cannot sell in dollars, right? They are precluded from participating in the SWIFT, settlement system. So all of a sudden, you have the Chinese very happy to facilitate that. So the renminbi is the currency that has taken up a big chunk of that 20% share. There are some smaller ones. For example, India buys some Russian oil in Emirati dirhams. Granted, Emirati dirhams is pegged to the dollar, so it's not quite de-dollarizing, but still, it's a different currency denomination, right? So again, we're going to see the US losing ground at the margin, but there is no other market has the same liquidity, the same depth. Treasuries, whether we like it or not, it's no longer the US has lost AAA rating from the 3 rating agencies. And we're still keeping the treasuries, we're basically ignoring that, right? Because we don't have alternatives, that's the reality. So I think that the dollar is going to keep probably at the margin losing weight in portfolios. People are going to be hedging more the currency risk. But, whether we like it or not, there's no replacement for the underlying asset, until another liquid market emerges. I don't think that any other currency is going to take over the dollar for the foreseeable future, basically. I think you tell me if you want to.
We have one more, a few minutes for one more question. If you can just pass the mic over there, coming from the back.
So I have a question with regards to last Fed meeting. They said, I quote, the committee will continue reducing its holding of treasury securities, agency debt and agency mortgage-based securities. So my question is, what is your outlook on this quantitative tightening, which will continue, as they said?
So I'm sorry, there was a little bit of echo. What is the outlook for what product or what market?
Quantitative tightening of Fed. So
The balance sheet?
yes.
So the Fed, as you know, during quantitative easing, they were accumulating treasury bonds. They stopped that. Now they're doing quantitative tightening, but they're doing it in a quote-unquote passive way, meaning that bonds that mature, treasury bonds that mature, are not replaced. They are not actively selling. Now, that process is going to stop, and I think it's going to stop at the end of this year, right? So which means that the Fed is basically going to keep its treasury position in its balance sheet constant. So they will stop tapering, they will stop quantitative tightening. They will, whatever matures gets replaced. So they're not going to be a source of net new additional demand, but they're not going to be a source of supply either. So they're going to be neutral, let's say, in the treasury market. What the Treasury, as I told you before, because of these concerns about the fiscal outlook, the interest of Treasury Secretary Besant to control the long end of the yield curve, the way in which they're doing that, they're not asking the Fed to buy. You know, maybe if they do a wholesale replacement of OMC next year, we may have QE again, who knows, right? But right now, the Fed is not basically doing much to support. The pressure is for them to cut rates because they think that by cutting rates, it's going to cheapen the debt service for the government, right? But the way in which they're controlling the long end is that they're not issuing too much in the long end. So there's not much supply happening at 10, 20, 30 years. A lot of the supply is happening in the short end. You know that that's probably dangerous because, you know, at some point you're going to have constant pressure to roll over debt, you know, which is never a good thing. But for the time being, that seems to be the way in which they're controlling the yield curve. I think that our time is up. Thank you so much for your attention.